Halloween City of Santa Barbara Finance Committee meeting, where we're going to have one item on the agenda, the quarterly investment report. Since there's no one here in the audience to comment on anything that's not on the agenda, we'll go straight to that. And Ms. Nemes, are you going to make the presentation?
I am. Thank you, Chair Hart, committee members. I am Julie Nemes. I'm the Treasury Manager for the Finance Department, and today I'll be presenting the quarterly investment report for the quarter ended October 31st, 2017. There are a few different areas I'll be going over today. First, I'll be covering the current interest rate environment and some economic factors that might be impacting interest rates. After that, I'll be going over the city's investment strategy and approach, some long-term trends on earnings and interest rates, and comparing our results against some common benchmarks, and finally, our quarter investment performance and activity results. So first of all, some information on the interest rate environment. As we've talked about over the last several quarterly investment reports, back in December 2015, the Federal Reserve, after 7 years, finally increased interest rates by 0.25%. And after that, they did it again 3 more times in December 2016, March 2017, and again in June 2017. So where it stands now, the current federal funds rate is a range of 1% to 1.25%. The Federal Reserve is again hinting at additional interest rate increase by calendar year end. There are 2 meetings remaining, one right now that's going on, October 31st, and tomorrow, November 1st. And then the last one is in mid-December. They could act either time or not at all. We do think it's more likely that if they do act, it'll be in December. We believe that based on some information that we've heard in polls and among economists, that the December meeting, it's a high likelihood that they will raise interest rates in December. These rate hikes do have impacts on Treasury yields, both at the time and actually leading up to the presumed hike. What this does is it also enables the Federal Reserve to cut rates when there is a recession. So that helps stimulate the economy, and it also prevents the Federal Reserve from having to go into negative interest rate territory like we've seen in Europe. Some additional information on the interest rate environment. I wanted to give you some economic factors that might impact rates and whether or not rate hikes will happen. The first couple ones are information that might result in additional rate hikes, and then the last few are have the opposite effect. So what we've been seeing recently is that the U.S. economy is expanding at a steady pace. The last few quarters, the GDP has been up over 3%. But I wanted to note that this could be a temporary impact. What we've been seeing, especially in the last quarter, is that the hurricanes have had an impact. And we're not sure what percentage of that 3% is due to that, but 70% of GDP is due to consumer spending. So hurricanes that went and destroyed things like cars and a lot of household goods, consumers have had to go out and replace all of those items. So part of that GDP increase is due to the replacement of destroyed items from the hurricanes. So that could be a temporary inflation in the GDP. Also, the unemployment rate continues to be very low. It's just over 4%. So we're nearing maximum employment, and that also could push interest rates higher. We're seeing an improvement in U.S. exports over the last about 6 months. In the past, exports had really been impacted, and we're starting to see an increase. In the last couple months, it's up about 0.5%. We're also seeing what we get often are surveys from manufacturing, what they call manufacturing outlook surveys from many cities, and we're seeing an increase in manufacturing and also a corresponding increase in exports to foreign countries. Part of that might be due to the U.S. dollar has weakened a little bit, so that helps with our exports. We're also seeing some stabilization in some foreign countries. That also can sometimes help our exports. Another impact could be presidential policies. We are expecting the president to announce a new Fed chair this week. He could actually appoint Yellen for another term, or he could go with somebody else. And it could be somebody that actually favors more rate hikes than what Yellen does. Also, the president's proposed tax plan, that also could have impacts on the economy and rate hikes. The last 3 are items that could have an opposite effect. We've been recently seeing a decrease in government spending and residential construction. Also, inflation continues to perform under 2%. It's at about 1.7% right now. And that was a target set by the Federal Reserve to increase rates. However, they really have backed off that target over the last year. They've continued to raise rates even though inflation continues to perform under that target. And the last item I wanted to note was that September did show job losses. And that generally is something that impacts the decision to increase rates. However, it appears a lot of that was due to the hurricane. So we think that could be a temporary impact on jobs. So just some additional information on the interest rate environment. Treasury yields continue to increase. Over the last 3 months, it was just slightly, but they are up pretty considerably over the last year. But they're still relatively low when you look at them compared to about 10 years ago. They are slightly higher, as I mentioned, as of September 30th compared to June 30th. The 2-year Treasury shows the largest increase at about 9 basis points. The biggest increases were in the 1 to 3 year range. I did want to point out, and we mention this every time, that it takes time for us to see any considerable increase in the portfolio yield because we have to wait for maturities before we can reinvest. So even though we're seeing these increases, it's time before we see any considerable impact on our interest earnings for the city. So this chart is, it shows our Treasury yields over the last 3 months from 6/30 to 9/30. It's all the way from 3-month to the 30-year. Also includes LAIF. As I mentioned, all of the yields are up for the last 3 months, but they're pretty small increases. The 2-year does show the biggest increase at 9 basis points. We generally invest in the 2 to 5 year range, sometimes the 1 year. So you'll see from at 2-year, it's 1.47% at 9/30, all the way to 5-year is 1.92%. The one thing I wanted to point out is that LAIF continues to increase pretty considerably. So the LAIF rate, it's a quarterly rate, has gone up 15 basis points over the last quarter. It's the short-term treasuries are the ones that continue to really perform well. And LAIF, a lot of what LAIF invests in is treasuries. Half of their portfolio is treasuries, and they're shorter term. The average days to maturity for LAIF is 190 days. Moving on to the city's investment strategy and approach. This is going to sound very familiar, but our primary objective is safety first. We really want to preserve principal. Our next objective is then liquidity, meeting the cash needs of the city, and finally then yield, earning a fair rate of return. We don't chase yields, we buy into the market. We also attempt to maintain a steady maturity over a 5-year period. It's really important in order to ensure we have adequate liquidity for the city, that we have cash for any projects or any needs for the city at all times. Also, it prevents us from investing too heavily in a bad interest rate environment, that we do not have too much cash at any point to have to invest it all at one time. It also ensures that we have cash at all times to be able to invest in a time when interest rates are better. This next chart is a comparison of our portfolio rate for the past 17 plus years, comparing it to the 2-year Treasury, the 5-year Treasury, and the LAIF rate. And what's important here is this is a good benchmark because it compares. It's important that the city's portfolio rate is really trending in line with these benchmarks. If it was significantly different, it would be something we'd want to look at further. And you'll notice that it does trend in line. Sometimes there's a slight timing difference because we do, as I mentioned, have to wait for things to mature before we can invest back in. And you'll notice over the last year, rates have picked up a little bit, and so has the portfolio rate. So right now, the city's portfolio rate is a few basis points lower than the 2-year. It's lower than the 5-year, but it's higher than LAIF's. But it is trending in line with both. I started providing this about a year ago to Finance Committee because I thought it was important to know, since it's about a month behind that we provide data for the quarterly investment report, what does the market look like now? What would we be getting if we were to invest right now? So this Treasury yield curve is as of last Friday. And it shows that all of the rates are actually higher today than they were at 9/30. LAIF, you'll see, is up several basis points to 1.14, and the 5-year has now broken that 2% line. It's been really hovering around 2%. It's been falling between 1.8 and about 2.08 for like the last 3 weeks. But all of them, every single rate has increased since 9/30. And we do believe part of that is in anticipation of a rate hike in December. So how did the city perform over the last quarter? The portfolio yield has gone up, and that is really reflective of interest rates going up over the last year. And as we invest back in, we invest at a higher rate. It's gone up from 1.372% at 6/30 to 1.439% at 9/30. Total interest earned during the quarter is $573,000. That is down about $16,000 from last quarter, and that's due to a decrease in our portfolio balance. You might recall at 6/30, we had a very significant increase in our portfolio balance. It was up at $187 million, which is very significant, much higher than we normally have in our portfolio. So that resulted in higher interest for the quarter. Our general fund portion is about $132,000. So our total cash and investments at 9/30 equates to about $162 million, about $25 million less than we had at 6/30. And I'm not sure if you recall, but at 6/30, we had set aside about $18 million we knew we needed to spend in July for prepayment of CalPERS. It helped us, it gave us about a $650,000 discount to prepay a portion of CalPERS rather than paying monthly. And so that makes up a big part of that difference in the balances. So a summary of our activity for the quarter. We had one purchase of a federal agency callable security of $2 million. We had no calls for the quarter, and we had $9.75 million in maturities for a net difference of negative 7.75, which basically means that's the amount that went back into our bank account. Of the maturities, $5 million are federal agency securities, and 4.75 are certificates of deposit, $4 million being the Union Bank one we've talked about at several meetings, and $750,000 are three separate certificates of deposit with three banks. A summary of our portfolio balance at 9/30. You'll see that our liquid, what we call our liquid balance, is made up of our checking account, and our LAIF balance is about $61 million. We have a little over $2 million in certificates of deposit, about $2 million in Treasury securities, $82 million in agencies, and $10 million in corporates. And then we have the airport note for a total of $162 million. The difference at 6/30 is we have about $17 million less in what we call our liquid balance. And as I mentioned, that's a lot to do with our CalPERS. We also have 4.75 less in CDs for those maturities and $3 million less in our securities. And I did also want to mention that this is a time of the year when we have less in revenues. We don't have any property taxes coming in during the summer, so we generally have a little bit less cash during this time as well. This last chart is just a different way of looking at our portfolio balance at 9/30. It's just a pie chart, and it shows what our portfolio is comprised of. And we have about half of our portfolio in agencies right now, 1% in treasuries. We have 1% in CDs because we had so many just mature in the last quarter, 6% in corporates, 3% in the airport note, and 38% in our liquid balance, 8% in the checking, and 30% in LAIF. We generally have more in our certificates of deposit. There usually is a little bit more of yield in CDs than we see in agencies, but that's when rates of return are higher. We generally see a bigger spread. Right now, there is very little difference between CDs and agencies, but we're still looking at CDs since so many just came back in to see if we might gain a little bit of yield that are still safe, just as safe as our agencies. So we're looking at that as well as to adhere to our new investment policy. So we'll be looking over that in our next quarter. And that brings us to recommended action. I can also answer any questions, but we are recommending to Finance Committee to recommend that Council accept and approve the first quarter investment report and fiscal agent report for fiscal year 18. Thank you.
Thank you, Ms. Nemes. Are there any questions? Councilmember Dominguez?
Can you please remind me the LAIF funds, how accessible are those or how liquid are they?
Chair Hart, Councilmember Dominguez, we can pull on them same day.
Same day?
Same day, yeah. By 10 a.m., we have to send a request and pull on the same day, and we can make several withdrawals in a month.
And the UB checking account, that's 8%. Is that pretty typical? Or is that a high balance?
We generally try to keep about $10 to $12 million in our checking account. So it'll just vary depending on the amount that's in our portfolio. But we generally, dollar-wise, try to keep about 10 to 12 million.
And is that because of potential emergencies, or that's how much you spend on a monthly basis? Or
It's just we like to keep that much in there due to cutting checks. We can have warrants. We can run warrants as much as $4 to $5 million in a day, depending on what's happening, big projects. And we run warrants twice a week. And so we also have outstanding warrants, so we have to look at what we have outstanding. And so it just gives us enough that we make sure that we never cut more than what's in our checking account.
And does payroll come out of that account as well?
That includes our payroll warrants. So that checking account covers our payroll warrants as well.
Okay. Great, thank you.
Any other questions? Councilmember White?
I'll move the staff recommendation.
Is there a second for the? Any discussion? All those in favor say aye. Aye. Opposed and abstain. Matter carries, and we are adjourned.